When a new hotel officially opens its doors, the physical construction ends and the daily operations immediately begin. The framework for managing this reality is laid out in Module 5, Grand Opening Plan and Post-Opening, specifically Lesson 5.4, Post-Opening Financial Governance. The Director of Finance must immediately pivot away from tracking ad hoc project spending and vendor deposits. The new baseline for financial leadership relies entirely on cyclical, standardized reporting. At the core of this routine is the monthly close. This process guarantees three distinct outputs: a finalized profit and loss statement, a balance sheet, and a cash flow statement. To be effective, all of this data must be compiled and verified within a strict timeline, typically 5 to 7 business days after the month ends. Financial success transitions from launching a physical building to enforcing rigid governance over time and data. Standardizing the timeline for gathering this data prevents transactions from bleeding over and blurring the lines between different months. The blueprint for achieving this is the monthly close standard operating procedure, a calendar-driven checklist. We can visualize this 7-day sprint through this timeline interface. The entire structure rests on 3 pillars of verification: accruals and prepayments, inventory and cost of goods sold, and AP and AR reconciliation. Each pillar has to be executed in this strict chronological sequence to protect the integrity of the data. They function as filters. As raw data moves through the sequence, operational noise is stripped away until only pure financial facts remain. Warning tone: missing the 7-day deadline renders the entire effort useless. The resulting data becomes too stale to guide strategic planning for the current month. A strict chronological structure acts as the singular defense against the chaos of daily operations. The most mathematically complex step in this sequence involves accruals and prepayments. The core accounting problem is timing. The hotel frequently consumes services and incurs expenses long before the vendor generates an actual invoice. This includes costs like estimated electricity and water usage or unbilled hours from contracted security and maintenance staff. To solve this, the finance department creates an accrual. As you can see in this 2-column ledger, an invoice that officially arrives in month B is mathematically forced back into month A as an estimated liability. By pulling that value back, the expense is tied directly to the exact time period the service was utilized, completely independent of when the cash actually leaves the bank account. Failing to execute this accrual breaks the accuracy of both months. Without pulling that expense into the correct period, month A's profits appear artificially high, delivering a false narrative directly to ownership. Accurately calculating true profitability requires matching financial actions to the passage of time, not the movement of cash. The Director of Finance must also manage the exact inverse scenario, accounting for massive expenses that are paid entirely upfront. Typical examples include annual insurance premiums or enterprise software licenses that cover the entire year. This requires amortization. Looking at this visualization of an annual software license, the single large upfront cost is mathematically sliced into 12 equal segments, with only one single segment dropping down as the current month's expense. The standard operating procedure mandates that only this exact fraction hits the profit and loss statement. The remaining 11 fractions are parked on the balance sheet as prepaid assets, waiting for their respective months. Through amortization, massive singular cash outlays are prevented from destroying the financial accuracy of any individual month. Once timing issues are resolved, the process shifts to the second major requirement: finalizing inventory and cost of goods sold, or COGS. This step demands a mandatory physical action at month end to verify the numbers. Staff must physically count all food, beverage, and high-value equipment. This physical count acts as the bridge connecting the real-world operations inside the hotel to the digital ledger. The raw physical count is then converted. In this abstract flow, you can see physical items like food and supplies passing through a scanner interface, turning into digital dollar figures and piping directly into the formula for cost of goods sold. That finalized, highly accurate COGS figure is then injected straight into the profit and loss statement. A digital financial record carries zero validity unless it is tethered to a strict physical count of reality. The final operational phase of the close focuses on ledger reconciliation for accounts receivable and accounts payable. The finance team balances two opposing forces: the city ledger, holding balances owed to the hotel, and the stack of outstanding vendor invoices representing debts the hotel owes. Both sets of balances must be meticulously reconciled against the central general ledger to ensure no line items are missing, but simply knowing what is owed is insufficient. These accounts must also undergo a rigorous process called aging. Aging categorizes these debts strictly by their due date. In this central ledger view, animated brackets sort the raw AR and AP data into specific time-bound buckets: 30 days, 60 days, and 90-plus days. Leaving ledgers unreconciled and unaged creates blind spots where toxic debts and hidden operational liabilities accumulate unnoticed. Once the 7-day sprint reaches the finish line, the monthly reporting cycle officially begins. The Director of Finance takes this completely reconciled dataset and translates it into the ultimate strategic deliverable, the owner's report. The core function of this report is variance analysis. This dashboard interface displays the matrix used to compare departmental accounts, mapping out positive and negative deltas across key metrics. The analysis systematically tests the finalized actual numbers against the original budget projections set at the start of the year. It then runs a secondary check, comparing the current actuals against the performance from the exact same month in the prior year to identify broader trends. This meticulous approach to tracking, verifying, and analyzing financial data is a defining feature of the Advanced Financial Leadership curriculum taught at the Europe Hotel School, London. Establishing a consistent, strictly governed monthly close serves as the absolute bedrock for building corporate trust and enabling effective, long-term financial planning.